Hello, good morning, everyone. Okay, brilliant. Thank you. So, I'm going to share my screen with you first. So, we've got a number of participants today, and I guess investment appraisal is a very interesting topic, and people want to understand more about investment appraisal. Now, well, this program is brought to you by Ultimate Access. My name is Andrew D'Alves, and Sandy Hood is joining me in presenting this topic. And let me share my screen with you. So 1 second, please. Some people are saying they can't hear me, so I'm just going to type something to them. 1 second. Just for a second. Now, I hope everyone can hear me and Sandy. Well, let us introduce ourselves. Sandy, introduce yourself. I know Sandy comes from the UK. How's the weather there, Sandy?
Well, the sun is up now.
Brilliant.
It's probably nothing like as hot as it is for the rest of you, but it's lovely and warm.
Right.
It's shining in through across my garden into my dining room.
Oh, brilliant.
And it's very, very pleasant. I was up earlier with a woolly jumper on,
Right.
as it was a little bit chilly from overnight.
Right.
But it's a pleasant temperature as far as I'm concerned. It's not baking hot.
Oh,
What's it
fantastic.
like for you?
Oh, it's pretty hot here. Yeah, it's
I
pretty
bet
hot.
it is.
Yeah. Still, the evenings
There's
are
no
quite
need for air
pleasant.
conditioning over here.
We really do need it. Yeah, we really do. Right. And talking about air conditioning and investments that go into buildings, isn't it? That's the topic that we're going to have today. And, well, we've introduced ourselves, that now we want to know a little bit about you guys. So I'm going to share my screen with you. We will be able to get a little bit more information about you guys by going to this site and understand where you come from, etc. Okay? Right, I like that. Let me go to the previous one. People are sending us hearts, Sandy.
Oh, lovely.
That's nice.
It's Easter weekend here in England,
Of
and
course it is.
Valentine's
Happy Easter.
was a few weeks ago.
Oh, wow. Green ones at that. Right, that's brilliant. That means...
That's lovely.
Yeah, beautiful. Thank you. All right. Now, let us see. Where do you currently live? That's the question that we want to find out from you guys. Right. Okay. I know there is quite a number of you, nearly close to 100 who've joined. So, yeah, go on. Right.
The UAE is in the lead at the moment.
Exactly. And others. We'll soon find out where these others come from. It's interesting, isn't it, Sandy, how people from different parts of the world joining us for this session.
Absolutely, yes.
Yeah, and this is a
We've
topic
had
that
people-
is applicable across the world, and not only for the accountants, actually for anyone. I mean, even for your personal life, it's important, to do capital investment appraisals. Right, let's go to the next one. Well, I've noticed there's some people who said, you come from other locations. What sort of locations do you come from? You can type the answer here, please. You can type the answer here. What sort of other locations do you come from? So I'll give you a few moments. Well, I'm going to the next slide then. What would you... This is an interesting question, isn't it, Sandy?
It is. It relates to what you do in an exam.
Right.
Yeah. What would you do in an exam?
Right. So I know there are members here as well. There are past finalists. Congratulations all. But if you're doing another exam, or if you're thinking of doing one of the exams, what would you do first? read the data and then read the task, or read the task and then read the data? And remember your response. Next question is not coming true. Well, thank you for letting me know. Sandy, can you see my screen?
Well, at the moment you've gone back to what are the other locations?
Yeah, I just went there because some people are saying the next screen is not coming on. Okay, said it came on now. Right. Okay, good. There is a bit of latency, I guess. What would you do first? Read the task and then read the data, or read the data and then read the task? Right. Remember your answers because it's important. So you can vote and then let's see how we go. Right. Interesting.
There's an overwhelming majority on the red.
Correct.
And a minority on the blue.
Yes, exactly. Correct. Yeah. And let us go to the next one. Oops, someone else voted. Let me check. Yeah. But still, majority is on this side. So remember, guys, we'll come back to this. Now, this is quite important for us to understand what your issues are with investment appraisal. So we want to find out, both Sandy and I, what areas in investment appraisal confuse you, gives you problems. So yeah, good. Discount, spot on. Deciding the discount rate specific to the industry. Yeah, and it's very subjective as well, isn't it?
Yes, certainly the calculation of the discount rate in the context of the industry recognises the risk associated with that particular industry.
Right, yes. Tax rate adjustments, well, good. Tax rate, depreciation, payout periods, yeah. Yeah, there's a lot of variables, isn't it, Sandy, with investment appraisals?
These are good questions, yes.
Yeah, good areas. Right. Anyone else? Payback period. Determining the discount rate. Yes, that's a repeated question that's coming true. Anything else, guys? Okay. Discount and payback. Yeah. Right. Okay. So there are some themes I can see here, Sandy.
Definitely. I'm trying to talk and write at the same time.
Right.
No, being a bloke, of course, I'm unable to do more than one thing at one time.
Right. Okay.
Between two investment options with periodic cash flows.
Yeah.
Okay,
Comparison between two investment options.
Rationing.
Yeah. Terminal value and valuation of companies. Well, good. That's Anyone else? Is NPV only relevant factor? Wow. Good one. Good one. Yes.
That's interesting. I wonder if the person asking that is asking that from a commercial point of view rather than an exam preparation.
Yeah, that's true.
From an exam preparation point of view, of course, we have to regard anything that's in the syllabus as being relevant. But
yes.
If you're doing it for your employer, or if you are the owner of the business, then you may only want to look at NPV, which is quite sensible.
Correct. Yeah. So I'm going to the next slide, which is, does NPV mean the same as capital investment appraisal? What do you think, guys?
I quite fancy that they're going to have some very good answers on this.
Yeah. Does NPV mean the same as capital investment appraisal? Right, good one. Nobody, oh yeah, I was just about to say nobody said not sure, but well, we've got all three colors now. That's
It
good.
looks prettier with the three colours. Yeah.
Yes. Making it very interesting for us. Yeah.
That's had 19 responses, 20. Oh, I think this has had more responses than any of the others.
Exactly, yeah. This is a good question, Sandy, that you put in. Very good.
Well, you put it into the Mentimeter.
Shows, yeah. So I'm going to the next slide, guys, if you've finished. Yeah. So, and this is a little bit more about yourself. Are you at university? Are you working? SEMA student, non-SEMA? It's just a bit of more information from you guys. Well, yeah, you've got 2 non-SEMA. That's great. Yeah. Very good. Yeah.
And I suppose some of you could be working and SEMA, whereas I don't suppose our questionnaire would allow that, would it? Yeah.
Yeah, I didn't. I think I didn't set it up that way. Yeah, you're right. It could be a working non-SEMA or working a SEMA student. That's true. Very good. So a lot of majority are working, and that gives actually a good stage, kind of the foundation as well, isn't it, Sandy, to kind of how to project our topic, because most of these people attending are working, so it will give us some context, how to build this topic as well. Right, and then over to you, Sandy.
Oh, lovely. And it's got today's date as well, which is even better.
Yes, it is.
Saturday the 15th of April.
Great. Yeah, we are on.
And we're looking at capital investment appraisal, evaluating long-term capital investment opportunities. I think this is very good. We're going to look at an example of the application of investment appraisal, and I've used an old exam question that was about taking a hotel library and converting it into a gymnasium. Next month we'll be looking at the determination of the cost of capital, or the discount rate. So 2 of you highlighted that as an area that you were particularly keen to look at, and a third one actually highlighted the fact that you might want to do something slightly differently if you were operating in an industry that you weren't normally operating in. That we're going to focus on applying a known discount rate, really. I mean, we will look a little bit at the discount rate, but next time, in a month's time, we'll be looking at determining the discount rate, and I think that you'll see how this month's class and next month's class actually work very closely together on that, which I think is going to be a big help. But this is looking at a hotel that has a library, perhaps not used a lot, used by a small number of the guests, and they're looking at trying to achieve a higher level of return by converting the library into a gymnasium and a spa. So here's the question. Which order for reading? Have I rushed ahead? So we're looking at the question. Talking too much, right? So which order for reading the data task, and these are the questions that you've already answered, which I'm very grateful for. And most of you thought that reading the task would be useful. I certainly do. I think that in the limited time you have in an exam, if you can read the task first, then it helps you to focus your mind as you read the data. This question is going to look at calculating net present value. It's going to look at the calculation of what we call a post-tax money cost of capital, at which this particular company would be indifferent. The word indifferent means that it wouldn't matter if they accepted or they didn't accept the project. And we'll also look at how we deal with inflation, perhaps using what we would call the real discount rate. and the difficulties that would have. So let's read about the data. The management of a hotel is considering expanding its facilities by providing a gymnasium and spa for the use of guests. It's expected that the additional facilities will result in an increase in the occupancy rate of the hotel and the rates that can be charged for each room. So you've got a double benefit. You've got volume of sales and average price both going up. The cost of refurbishing the space, which is currently used as a library, and of installing the spa is estimated to be $100,000, and the cost of additional equipment is another $50,000. The gymnasium and spa will need to be refurbished and the equipment replaced every 4 years. So from an accounting exam point of view, then we're looking at a 4-year cycle here. The equipment will be sold for $15,000 cash at the end of the year 4, and this amount includes the effect of inflation. So at this stage, this word inflation has arrived, but it's rather ambiguous. We don't know exactly what the rate is. The hotel accountants have produced a feasibility report at a cost of $10,000, and the key findings from their report regarding occupancy rates and room rates are as follows. So we've got the current occupancy rate of 80,000, number of rooms available 40, current average room rate per night $250, occupancy rates following the gymnasium have been, the market research has indicated that they're going to go up to 82%, and the average room rate will go up by 5%, excluding the effect of inflation. So we've got inflation as well, so that on the previous slide we got mention of inflation. Here inflation gets another mention. Would anybody like to very quickly tell me about this feasibility report? Will we need to discount for this? Okay, have we had anybody volunteer to say what on earth we do with the £10,000 that we spent on the feasibility report?
Yeah, that's a very good question, because how do you treat it, isn't it? How do you treat this from an accounting perspective?
So I've had one answer that says we don't need to discount it. Have we had any other answers?
I've got cost of capital, sunk cost.
Oh, much better.
Initial
it's a sunk cost.
Initial investment.
Well done.
Yeah.
Yeah.
Rizwan, yeah.
So as a sunk cost, we ignore it, don't we? Because it's already been spent. It's not going to affect our decision.
So Kumail and Faisal, very good. Sunk cost, they've stated.
Excellent.
Great.
Right, some more information. Other information relevant to the is that the staffing of the gym will have 4 employees, and we're going to pay them on average $30,000 a year. And the current budgeted overhead absorption rate is $80 per square metre per annum. The area required is 400 square metres, and in addition to that, the hotel's overheads are expected to increase by $42,000 directly as a result of opening the gymnasium and spa. The inflation is expected to be at a rate of 4% per annum and will apply to sales revenue, overhead costs and staff costs. And the rate of 4% will apply from year 2 to each of the subsequent years of the project. So it gives us an idea that the initial figures are going to be accurate for year 1, and that we'll only need to inflate them as we start year 2 and so on. A bit of tax. Certainly we had tax mentioned within the areas. Yes, that's
right. Yeah, people mentioned, isn't it? Quite a number of people mentioned about this tax. So this will, sort that out.
Excellent. Tax depreciation available on all costs of refurbishing, installation and equipment. So that's going to be all of our investment expenditure can be depreciated in this particular country, because they have a tax regime that allows it, and they're going to allow a 25% reducing balance per year method. And then the tax rate, 30% of profit, of taxable profit, is going to be taxed, and half the tax would be payable in the year in which it arises, and the balance is paid the following year. And then any losses resulting from this investment can be set against taxable profits made by the company's other business activities. So that's quite significant. I'm sure many of you are well aware of this, that you need, in order to be in keeping with the IAS 16 requirements, that you need to make sure that your tax is properly adjusted for, but also that within the country that you're dealing with, that you see whether or not activities in one part of the business are sufficiently profitable to therefore mean that you're able to get the tax advantages in another area of the business where there may be some losses. And the company uses post-tax money cost of capital of 12%, and that's used to evaluate projects of this type. So here we are, we're back with the question, and I've got to ask you, particularly the two people who said that they preferred to read the task first, did you find that reading the task first, before the data, helped you to focus what you were looking for when you were reading the information? Fair enough.
Yeah, that's right. So people are saying it is definitely helping them, which is great.
I think that certainly within the... Sorry.
This is a very important aspect, isn't it? Otherwise people waste time at the exams going back and forth, going through the task and the scenario. Yeah, Sandy.
Exactly. Yeah. I mean, when you're doing it in business, then you're looking at the task straight away. You're told that come into the office, I want you to do the appraisal of this particular investment, so you know what you're doing, and then you go off and you find the information. So you're not doing anything different from what you would do in a real world situation. You're getting the question first, and then you're going off and getting the information that enables you to answer it. So here we've got 16 marks. Typically an exam would allow 1.8 minutes for a mark. So you've got just under half an hour, about 28.8 minutes to answer a question like this. We've used some of that in order to read it already, so we are working our way through. What we're going to do, we're going to work through the information given from start to finish using a three-table approach. And we need to know what the operating cash flows and tax are. We need to recognise how the investment will provide a cash saving as the tax depreciation is applied. And we need to combine these in order to give us a net present value. So you'll see three tables, and the first of these tables will look a bit like this. We've got the year 0, which is the sort of instant now, and year 5, which is the year following the end of the sale of the equipment, and then there's years 1, 2, 3 and 4, which are the operating years. So we've got all of those years included here, and then we'll look at the each row will be information that will help us to generate two figures. First of all, we want to know what the profit is. Secondly, we want to know what the tax cash flow is. And when we talk about profit, we don't get bogged down with accounting depreciation or anything like that, because that will be dealt with when we look at the tax table. Now in the tax table, I've written two row headers. I've got a row header called WDV, which is what I use to mean the written down value, what the tax authorities consider the value of the asset is. And WDA is the written down amount, and that's going to be the difference between the opening value of the asset at the beginning of the year and the closing value of the asset at the end of the year. So how much has been written down over the year. And then from there we can calculate a tax saving. We were given some percentages, and we can recognise that because we know from the information we've been given that some of our tax has to be paid in the year in which it's the profit has been made or the loss has been made, and some of our tax is paid in the following year. So we can get that onto this second table. And the third table is a net present value table where we aggregate all the figures that we've got, and we're able to generate a net present value, and from there that can be used as a financial reason to either go ahead or to reject the proposed project. And these three tables will very often fit onto an A4 sheet of paper, so effectively you're writing your years across the top, and then you're just sort of working down almost like 3 paragraphs. So this can work very fast in the limited time that you have in an exam.
Just for the others, Sandy, I mean, if for the people who are working, right, it's all, I mean, because these days everything will be in the computers, isn't it? So the important thing is to have those three tables in one Excel, and then that'll kind of link one to the other, isn't it?
Yes, and what's lovely about doing it in Excel is that when you've done it, if your job requires you to do quite a lot of investment appraisals, very often you can use the 3 tables, and if you construct them in such a way that you're then feeding additional information into a template, then you can be generating your net present value calculations very fast.
Yes.
And that can be very useful indeed, because it can help you with some of the more practical questions that you might have at work that might not necessarily come in an exam, along the lines of, well, what would happen? What would be our net present value if our sales revenue were to drop by 10%?
Yes.
Perhaps because the sales volume drops. Then we can look at, because the cells are formatted, we'll have a recognition of fixed and variable costs, and the whole thing will cascade through very quickly.
I need to ask a question from our attendees. Just want to find out, has anybody created this type of template? Is anyone working with this type of template at work? Just want to find out, out of curiosity, because that's a very efficient way of doing it, isn't it, Sandy?
It is.
Thank you.
I remember in the late 1980s,
right,
when we didn't really have the same sort of facilities.
Yes.
Having to write these things out. I mean, we were typing them out.
Right.
But we were having to write them out, and effectively, it was a whole new set of sums, because we didn't have the facility to be able to go into an Excel spreadsheet or the predecessors of Excel to do all that donkey work for us.
Yes, that's right.
We had to actually do it all line by line by line, and it was much more time consuming. Yeah.
Yes, and we got quite a few people. Asan is saying, Kumail, Yasser, Kumail, and saying yes, they have used it in the past, that's good. All right, over to you, Sandy. I guess we will speed up a bit.
Okay. Well, I can see Shive has done many appraisals recently, so that's good. So
yes,
I think the more you do, the more you recognise the need for particular figures and so on, and it's very valuable when you've completed one to not necessarily get bogged down with the nuts and bolts and the specific details of that particular project, but if you were to review the process, how you carried it out, then that can be useful for when you do your next one and the one afterwards. And it becomes a little bit individual company specific, because you begin to recognise, horrible though it might sound, that the information that you're collecting from certain members of staff are more reliable than the information that you're being given by other members of staff.
Yes, that's
and
correct.
You begin to get that, you get that feel of the reliability, and it's all useful from a real point of view. But in here, we've got these costs. We've got 100,000 going in as an expense for installing the spa, another 50,000 for the new equipment, and then in year 4 we're going to have a 15,000 cash inflow as we sell the equipment to somebody else. So that goes straight into our investment costs, and of course I've got in here that it includes the effect of inflation, and so here they've got these cash flows, and they've gone straight into table 3. And I emphasise this includes inflation because what we're looking at is money values. We're looking at the values as they exist in the money that we are actually paying out and money that we are receiving back. So I'm not, certainly on my screen I can't quite see the full description next to the word discount, but what I typed in was money rate. The discount factor that we will have to use here is the money rate discount factor.
So I will ask a question from the audience then. Do you guys know what money rate is? Anyone? So if you can give the definition, what is money rate? Let's see, Sandy, because we've got some very savvy people out here.
Definitely.
Yeah. So I'm just waiting for people to answer, to say whether you know what money rate is. Today's value rate, says Asan. Yeah. What about the others? So we don't have many people saying what it is. So do you want to elaborate a little bit, Sandy?
Yeah, money rates are the inflated one, so it includes inflation. We're looking at the real money that's coming in.
Yeah. So that means it's including inflation, correct? That's what it is.
And here's a little bit about the feasibility report, and this was a question I was asking earlier, and we had some very good answers. Yes, this is sunk cost, so it won't go in anywhere.
Correct.
And of course the other figures we'll look at now. The costs without the gym, the revenues without the gym and the revenues with the gym are significant. There are 3 key words that we will always look for, or 3 key expressions that we'll always look for when we are classifying revenues and costs that need to be included within a capital investment appraisal. To sort of start the ball rolling, the first one is they must be a future cost, and as such the feasibility is a historic cost, and so will not be incurred if we do it. It's not a cost that will only be incurred if we go ahead and do it. It's a cost that is incurred whether we do it or not. So that isn't a future cost. But can anybody remember what the other 2 expressions are about the costs and revenues that go into a capital investment appraisal?
So what are the other 2 costs? You said, Sandy, right? What are the other 2 costs?
I said that one of them was future.
Yes.
All right, differential's very good.
Wow, yes, very good, Shoaib.
Yeah, that wasn't the word I was thinking of, but it means exactly the same.
Relevant cost?
Well, relevant is the general description. So a relevant cost, it must be in the future. It must be a differential,
cost?
or what I call incremental, yes.
Opportunity cost?
An opportunity cost will very often be an incremental future.
Yeah.
And the other one is cash flows. So I've been rather kind on this slide because I've said we want the incremental future cash flows.
Yes.
So they're the 3 keys. If you tick all 3 boxes, then you're dealing with a relevant cost, and it's only relevant costs that are going to go into our analysis. So here we're going to look at revenues, and so we need to know what the revenues would be without the gym, and we need to know what the revenues would be with the gym, because it's only the incremental, it's only the extra revenue that's going to go and be useful for us in our final calculation. So if we look here, I've taken that information and I've got as things stand at the moment, we've got an 80% occupancy, 40 rooms, $250 a night, 360 nights a year. That gives me a revenue of 2.88 million, whereas in the future it'll be an 82% occupancy that would lead into a revenue of 3.99 million. So we're going to be looking at the difference between those two. That's incremental. Next bit of information. 4 members of staff, each on 30,000 a year, so we're going to need to add that to table 1. And the staff cost has gone in there as 120. You can see I'm not filling in all the columns yet because I know that there's some inflation going on, but these figures can go straight in. Overheads, budgeted overhead absorption rate, and the hotel overheads expected to increase. So I have, these were the 3 questions I was asking you a minute ago. So I jumped the gun with that, didn't I? But let's have a look. Do the overhead absorption rate for the hotel, does it meet all 3? Do we tick all 3 boxes? Would you like to put an answer in the chat box?
What do you guys think? Yeah, let us see what your answers are. Shoaib says incremental. Yes. What about the others? It's not incremental. Some say. Okay, Rizwan also agrees with Shoaib. Incremental. Akbar says incremental. Yeah, so many people are saying incremental. Asan, Kasif, Yasser. Yeah, good. So I'm getting answers. Guys, participate. It's good to participate.
Well
Mohammed, Riyaz.
So I've said that they are future costs. That gets a tick. I've said that they're not incremental. The hotel will incur these costs whether or not the project goes ahead.
Right.
And that we don't know enough to know whether they're going to be cash costs. The suspicion is they're probably not. And because it hasn't ticked all 3 boxes, it doesn't go into our analysis. It's not a relevant cost.
Right.
Let's try the next one. The hotel overheads are expected to increase by 42,000 directly as a result of opening the gymnasium and spa.
So here you want to know, is it a future, incremental or cash cost?
Yeah. How many ticks are we going to get here?
What do you guys think? 3 ticks? All are 3. Riyaz says future and incremental.
Mohammed said all 3?
Yes.
Good. Kashif? Flowers, future incremental?
Yeah.
Okay.
His son says all 3.
I think we have to take the cash on trust, but yes, ultimately there will be some cash leaving the hotel, and I can appreciate that you recognise that very often we're dealing with bank transfers, but we would consider that a bank transfer would be a cash transaction. So here we are, we've got all 3 ticks, so we're going to include them. And there they go, 42 down the bottom as the overheads cost that we're going to incorporate within our operating cash flows.
Yes.
We've got a bit of inflation now, 4% per annum applying to sales revenue, overhead costs and to staff costs. Now that's quite kind if an examiner gives us that, because it means that we can net them off if we should so wish, and then we're only having to do one 4% calculation rather than do it to all the figures. So we can take the figures that we've been dealing with now, that we have in year 0, and we can transfer them into year 1. There won't be operating cash flows in year 0. when we look at capital investment appraisal, we're looking at the last day of the year. So effectively year zero is the last day of the year before we get started, which is basically the same as day one. And so we've treated the investment as taking place in year zero, but the operating cash flows don't start until year one. And we've got a 4% increase in those values that goes on from year two. So in here, I've put in the revenue without the investment, the revenue with the investment and without, and then we've got to take away some. So we can see at the bottom, the incremental revenue is the 219.6, and we've also got the staff costs and we've got the overheads. So these figures in the operating cash flows now, we've got fewer figures so that it's more summarized. And then we take each value and increase it by 4%. And as I was saying, we have 4% for all three values. So what we can do is we can work out the contribution. So we've got a contribution.
That's a fast way of doing it, isn't it? Wow.
It saves time.
Yes.
It saves time. I could be inflating the revenue, the staff costs and the overheads by 4%, but ultimately the figure we really want is what the revenue less the costs is. So it just saves us doing a lot more sums. Yeah.
Correct.
And in an exam, unlike at work with a spreadsheet, you don't have the opportunity of just sort of dragging your formula across. You have to keep typing it into the calculator. So it's a good use of exam time, and if you are doing this at work, it's quite a useful way of cross-checking to make sure that you're working out your figures correctly. We now look at tax, and we've seen this slide before. So we've got to deal with the tax both as a capital impact. So we've got the investment itself is subject to tax depreciation, and we've got the tax in terms of the tax that's going to be levied on the operating cash flows. So it's going to go into both Table 2 and Table 1. So looking at Table 2, we know the initial cost is 150,000, and that we can apply tax depreciation of 25% on a reducing balance basis. If I would tend to recommend going into an exam with a conventional standard sort of calculator, as well as going in with a statistical one. And sometimes on the conventional calculators you can actually do quite quick sums if you're doing the same sum again and again by putting a constant in, which you can't always do with statistical calculators. So I would go straight across the top saying the written down value is going to be 75%. In other words, after you've taken the 25% off, it's going to be 75% of the previous year's figure. And you just go bing, 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 putting in all your 75%. And then, of course, you know that in year 4, you've got a residual value of 15, so that stays in. So let's see the next slide, and you'll see how I've done this. So I've said 75%, 75%, 75%, and then I know that the final figure is 15 because that was given to us in the question. And then the differences are these figures. So the 25% of 150 is the same as 150 minus 112.5, and 112.5 minus 84.4 gives us a 28.1. So these figures are the amount that the tax authority has allowed us to treat as taxable costs within the year. And you know, the more costs you have, the less profit you make, and so the less tax you have to pay. So here we've got 37,500 in the first year, and it's going down each year. And So I apply that 30% tax saving to that year's accounts, and then that gives me the tax saving amount. So here you can see that in year one, as far as the accounting reporting aspects for the tax is concerned, we've got a tax saving of 11,300 because that was the 30% of the written down amount, and that works its way across. And if you look in year four, there's a slight bulge because the reduction in the value of the equipment and so on is greater, isn't it? It's gone from 63.3 in year 3 down to 15 in year 4. So we've had a reduction in the value of 48.3. Now, in conventional sort of tax aspects, we'd be calling this a balancing allowance, but we don't need to worry too much about that because it's built in to the nature of our calculation. So we've got a single figure for year 4 of 48.3, and then we need to apply the cash flow aspect, and I've highlighted this in yellow. Half the tax is payable in the year in which it arises, and half is paid the following year. So the cash flow, the figure that's going to be transferred into our table 3, is going to be the figure that comes here. 5.6 in year 1 being half of the tax saving for year 1, 5.7 being the other half that would then appear in year 2. And I've netted them off, so we've got these tax saving amounts that we can then put into our table 3, and that's going to help us to work out our net present value. We've also got to deal with tax on the operating cash flows. So here I've identified that the contribution that we've made each year, year 1, year 2, year 3 and so on, is subject to tax that we would have to pay on. And here in year 1, 30% of 57.6 is 17.3, and 18 in year 2 and so on. So these are the tax calculations and how much we would have to charge ourselves for tax in that year. And then I've applied the same cash flow approach where we've split it half and half, so that we're able to see half going into 1 year, half going into the following year. So we take those bits of information, and we can now use them within the net present value table. The net present value table needs the investment information. Well, we've put that in already. We're going to add in the operating profit or the contribution, and we're going to add in the tax on that profit, and then we'll add in the tax savings that we've generated through the tax depreciation. And this is useful at work because in the event that something changes, imagine that you had additional information that came in later on, that you can very readily modify your figures so that you're able to keep it up to date with the freshest information that you've got at your disposal. And it's also very good in an exam because it's very clear for the marker who's probably marking at great speed. It's very clear for that marker to be able to spot where you've got your figures from, and in the event of an error they can identify that quickly and see whether or not your carried forward figures are merely the result of an earlier error or whether you've made subsequent errors. So it's good for that because that helps you to get more marks. So slotting them in, I've got my investment and my equipment up at the top, and then the operating profit generated, you can see it across here, and then the two tax figures that we've just been calculating, and that enables me to identify a net cash flow each year. And as we can see, we need all 6 columns, don't we? We've got the 150 in year 0, going all the way through to minus 2.4 in year 5, mainly because the tax on operations is greater than the tax saving on the depreciation. So can you see how those 3 tables have then slotted together, and how we've taken the information from 1 and fed it into 3, taken the information from 2 and fed it into 3? For those of you familiar with workings in a financial accounting scenario, it's very similar to that sort of thing. We're producing the end result. But when we produce this is very useful from a senior manager's point of view, because they can see instantly. They're not being bombarded by a huge table. They can see instantly the key figures and the overall outcome.
Sandy, I've got a question here. So this means the best way of structuring not only your answer but also even a work situation, so that you prepare those 3 tables, and that gives you all the underlying information that's required, and then you just feed in those information into the tables, and then you're able to bring it to that one place. Because if you missed certain things, you'll not be able to kind of easily identify, isn't it?
Exactly. It makes it very easy. And if you take the tax table, for example, if there was a change in the half in one year, half in the next year routine, you would only have to modify that at work, and instantly the figures that would be carried into the final table would be automatically changed.
Correct, thanks.
Excellent.
We are nicely heading towards that time, which is good. So thank you.
We're using the post-tax money cost of capital. We talked about this. We know what we're dealing with here. It's a cost of capital that recognises inflation, and so that goes in. Okay, how would we have found it? That's one of the questions that
so I've got a question
we were asked
here
earlier
from a student, from one of the attendees, saying 5 years cash flow, is that the best practice, or it depends on the industry? I think very relevant question actually. Thanks, Mohammed, for putting up this question.
Well, in this particular case, we were told that we would have to renew the equipment after 5 years. We were told, after 4 years. We were told that we were installing gym equipment into this particular part of the hotel. And it may well be that there are health requirements that may be imposed upon gym operators that require them to replace gym equipment after a certain number of years, simply because the local government wants to maintain the safety of the gym users. And if that was the case, then that would make a natural point to carry out your investment appraisal.
And I think Mohammed, to answer your question, it does depend on not only the industry but also that particular, like Sandy quite correctly said, even the industry is one thing, but the equipment, what it is used for. If you're in oil and gas, that'll be a different story. It'll have more stringent requirements and that we have to adhere to, and we need to abide by those. And let's say in a hotel, there might be refurbishment that needs to happen every 3-4 years. Then you consider that. All right. Thank you, Sandy.
And sometimes we come across IT projects.
Yes.
And even if you're looking at your sales staff and their mobile phones, perhaps, and you're seeing that as an investment, it may make sense to have a very short investment appraisal cycle for that.
Yes.
Simply because you'd want them to have the latest equipment, say, in 3 years' time, rather than start to slip behind the competitors, because ultimately that could mean that they lose sales. Yeah.
Yes, and I have an actual example of that, because when I was working in the telecom industry, this did happen. And first we wrote down it was 4 years, but then we had to accelerate because technology was changing, and we had to accelerate the written down part of it. Yeah.
Exactly. Yeah. So much though I would like to say that there was a cut and dried figure that you could use all the time.
Yeah.
I'm sorry, I have to say that there isn't. Yeah.
All right. Thank you.
Finding the discount rate for investment projects will be subject in our third session. So I know that there was a couple of you that were particularly keen on that, but we would have found the discount rate in this hotel probably using the company's own overdraft. This is a very practical way of finding your cost of capital. The bank that you bank with will understand the business, and the bank will know how risky the business is, and so on that basis they will charge a particular rate of interest on your bank account that they might not charge on another company's bank account. So a whole series of different factors come into the determination of overdraft interest rates, but it's specific to your business because of the way you've operated in the past, because of the nature of the activities that you engage in. So as a rough and ready approximation, and certainly if I was asked to go into an organisation and we had to come up with an investment appraisal, I would probably see how much the bank is charging them for their overdraft, and we would probably use that on a practical basis. But as we work into next month's session, you'll see that we do deal with a series of calculations that bring together where the funding is coming from. So it combines the equity funding with the debt funding. So here we've used a 12% discount rate. Invariably, accounting students in exams are able to access a table for this, and the table will then generate the discount factors that you apply. I mean, you're effectively dividing your cash flow by 1 plus the discount rate to the power of the number of years, and that then gives you present values that you can then put together as a net present value. I saw somebody make reference to the weighted average cost of capital. Yes, that is the topic of next month's class. So here we've got calculate the net present value of 20,600, and this is all the question asked. Another question might say, would you recommend that this investment should proceed on financial grounds? And I would ask you, would you recommend that the hotel go ahead with this conversion?
What do you think, guys? Well, Hassan says yes.
Yeah, that's a very quick yes, straight in there. Another yes.
Yes, Hassan says yes.
I think we're all in agreement here that this is a financially worthwhile proposition because it's got a positive net present value.
Right.
Well done.
Yeah. That's right, Hassan. Seeing the positive NPV.
So here, if I know that the ones of you who are doing this for exam purposes are in the minority, but I'll just quickly whiz through just to show where the marks would have been accumulated. 3 marks here would have been for current revenue and future projected revenue and incremental revenue. Ultimately, if you've got the right answer, they wouldn't go into this detail, they'd just give you the 16 marks. But it just goes to show that you can make an error and you can carry that error forward and you're still earning good marks. And the biggest chunk here comes from the tax calculations and the phasing of the cash flows. So the recognition of both how you calculate what tax is due, the 30% of whatever the value was, whether it's the written down amount or the operating profit, and the splitting of it into the amount that's payable in the year and the amount that's payable in the following year. Common errors, well, the common errors were identified as being failure to calculate incremental revenue, including non-relevant costs in the cash flows. I think we recognised the idea of relevance. Silly things like missing out the residual value. I think a disciplined approach such as ours, where we're putting in figures as soon as we find them, means that we don't tend to have these omission problems. Not reading the question, using 365 days in the calculation when the question had asked for 360. Not calculating the year for tax depreciation correctly. I think that is a problematic area that students have had over the years, but I think using the approach that we have of identifying the written down values first and then going back and finding the differences for the written down amounts means that you don't really have that issue. And then incorrect phasing of the benefit and tax depreciation, which was one of the points about the timing of the cash flows. Now, here's a question. It says calculate the post-tax money cost of capital where they would be indifferent. So I suspect we know what the word indifferent means. I'm going to suggest that we don't mind either way. So when somebody says, would you like to drive or would you like to sit in the passenger seat, and you shrug your shoulders, hopefully shrugging your shoulders doesn't have any other meaning. It simply means I'm quite happy either way, and that's what indifferent means. So here, if we're indifferent, then it means that we don't mind whether we take the project or don't take the project. It doesn't make a lot of difference to us. And I've just seen that on the top of my screen, someone has very quickly identified that the post-tax, and another one, very well done, the post-tax money cost of capital will be indifferent, is called the internal rate of return. Very well done.
Very good, IRR, very good, Hassan.
So very, very well done. The internal rate of return, and we know that the internal rate of return can be found more precisely if we can get two figures that are fairly close together. But in exam there isn't a lot of time, and if we've done an NPV as we have and found that this has got a positive net present value at 12%, we know that the project has got an internal rate of return which is greater than 12%. So using that knowledge, I would tend to look for a net present value calculation that would give me a minus figure, and given that I'm likely to be using tables in the context of an exam, the tables tend to go up to a maximum of 20, so I would tend to go straight for 20 just because it would make my life easier. And here I've got two sets of net present values. I've got the net present value that we've worked out already of 20.6, and then if I was to use a discount rate of 20%, I find I've got a net present value of minus 5.3, and that tells me that I've got an internal rate of return somewhere between the two. And I've taken a little screenshot here of the formula for working out the internal rate of return. We know it's going to be RA, which is the 12%, plus something multiplied by the difference between the 20 and the 12. So it's going to be closer to 20, isn't it? Because it was a smaller value than it was for the 12%. And in this case, it works out as 18.36%. Well, I'd certainly if we were at work, I'd say it was just over 18%, and wouldn't really want to get into the decimal places. but if the examiners asked me for 2 decimal places, then I would put that in. So 18.36% would be the post-tax money cost of capital where the hotel would be indifferent. How would the hotel use this information? Well, they would use the information by comparing it with the costs that they're incurring from the money that they're having to borrow, and seeing whether or not 18.36 is a better return than it's costing them. I think the other thing that's quite useful is that very often you're dealing with boards of directors who perhaps been at university and they've handed in their essays for their history homeworks and all the rest of it and got percentage marks, so they understand percentages more easily than they understand the net present value values. So sometimes communicating with senior management is easier using IRRs than it is using net present values. But I think between you and me that the net present value is a more useful and more precise amount, because you're looking at how much in money you're adding to the shareholders' wealth. Now I'm concerned that we're getting a bit close to an hour, so we're a little bit quicker at this stage, if that's all right with you. And the examiner's comments on that particular question were that candidates recognised the need for an IRR calculation. They scored well, but there was plenty who didn't. But I was very proud of you, because you recognised straight away that question, using the language that it did, which was a little bit misleading, was asking precisely for what the IRR is. Well done. Now, discuss an alternative method for the treatment of inflation that would result in the same net present value. So we've dealt with a money rate approach when we've been dealing with inflation. In other words, we've inflated all the costs, we've inflated all the revenues on the basis of the inflation rate, and then we've discounted them at the post-tax money cost of capital. Can any of you think of the name of the discount rate that we use when we're dealing with not inflated figures? I'll give you a clue. Well done, Shoaib. The real rate of return. Excellent. So we're looking at the real cost of capital, and as you may have spotted, there's only 4 little blanks on my screen giving a clue that it was a 4-letter word. The real cost of capital. So we would use the real cash flows, we wouldn't inflate them, and that would be fine for sales revenue, it would be fine for labour, it would be fine for overheads. So we would get these uninflated figures. And the investment cost cash flows would also be fine, but you can see in here that I've put in a residual amount of 12.8, because I've had to kind of assume that we're dealing with the real value, and in 4 years' time it would have what we would be getting as a cash value of 15 would need to have been reduced. So although we haven't been told, I would assume that we're looking at a real value of about 12,800 for the residual amount. So we're beginning to see that it gets a bit more complicated when you're dealing with real values, because you're having to discount them back. And then the tax cash flows become a bit more of a problem. The tax cash flows are split. Part of it's in 1 year, part of it's in another year. Well, when we're discounting them, that means that part of them are getting discounted one way, part of them are discounted at a higher rate. And the other thing about the tax cash flows are that they're not inflated. So when we're dealing with the tax depreciation, we start with the initial written down value of the asset and we reduce it by 25% each year. There's no built-in inflation aspect in there, simply because there's no cash flow that's taking place in terms of us paying for more equipment. The cash flow that's taking place is the tax that we hand over to the tax authority. So that's another little complication that you can build into your calculations, but it does mean that when you're calculating it on a real basis, it's a more complex calculation. Here, the discount rate that we would use would have to be the real rate, and the real rate we would work out by using the nominal or money rate divided by the rate of inflation, and in this case it would be 7.7%. You get the calculation divided one by the other. So here, applying the tax and so on using the 7.7%, we would still get the same overall answer, but we would have had to have gone through a lot more calculations to get there. What did the examiners say when they set it on the exam? Explanations given for the difficulties in using this method were vague and did not demonstrate a clear understanding. So I think we're pretty much on track. Capital investment appraisal could go a lot further. I think some of you are well aware that we could look into other aspects to do with capital investment appraisal, but it's a method of calculation that identifies the effect of a decision on the shareholders' value of the company. If we found a capital investment decision which would provide a positive net present value, that positive net present value, instantly the decision is made, adds value to the company, even before anything has got started. And so it's very, very useful in that respect. There can be working capital cash flows, sure, we haven't looked at those, but yes, they would perhaps take place over the life of the project. We could even have differing rates of inflation for different costs. There may be some foreign currency translation needs. And it's an exciting area for management accounting. And certainly, I've often talked to people about their sort of home lives and so on, that in the UK, if somebody's got a house and that they want to extend the house, they have to apply for planning permission. So as soon as the application for planning permission has been granted, the value of the house goes up, and yet the builder hasn't even arrived and put the first brick on that extension. It's simply the decision to go ahead with it, and the fact that you've got permission to go ahead with it is enough to add value. And that's just like capital investment appraisal, that you're looking at how you add value by the decisions that you take. Well, I hope this hour's session has given you a good taste and you want to explore it further. I have a suspicion that I've got... Oh yeah, and we hope to see you on May the 13th. And May the 13th will certainly be the one when we're able to look at the calculation of the discount rate or the cost of capital. And as Shoaib, I think, was saying, that we will bring together the information that we have about the company's cost of equity and the company's cost of debt. Any further points or questions?
Any questions, guys? Thank you, Sandy. That was great. Very informative. Any questions from you guys?
I hope it didn't feel rushed at the end.
Can we get a copy of the slides shown today? Yes, we will be providing a copy of the slides to all. Any other questions? So I have a few questions to you guys. Well, there's Shoaib asking another question. Can we include RARR in the next session?
I think I might need a bit of help in terms of RARR. Is it accounting rate of return that you're asking about, Shoaib?
Yeah, I think so. Yeah, so I want to ask you guys, are there any people here doing CIMA case studies in the May exam? Anyone here doing OCS, SCS? Okay, Shoaib.
So
all right.
You're doing FIS. You're doing FIS, is that right? Yeah.
Yeah. MCS, right. So some of the points that Sandy made, and they were really good, because as you can see in your case study, one of the things that CIMA does currently is they don't want you to do all these calculations. However, they ask you more difficult questions because computers can do all the calculations, right? So what they do is they want you to interpret. For example, that feasibility study, there could be $1 million invested in that feasibility study, and you would be, your senior managers have no clue, should we include this or not, right? Because they are not in the management accounting space, so they will be asking, wondering, should I include it or not? And you will be asked the question at a board meeting. So, or for you to write a paper on why shouldn't we include this, and it's a significant amount of money, right? You should know how to interpret that. Now, another thing that Sandy very well, Sandy explained the NPV and the IRR and said, well, what is the meaning behind that 18% actually, right? And why do we give it as a percentage? Why do we communicate like that? So when it comes to, your stakeholder management, understanding who your stakeholders are and how to communicate, what to communicate is also quite important, right? So these are very important areas to consider. So we have, one thing is for you to understand technically how this the whole thing works, but the next very, very important aspect in real life as well, and CIMA is definitely testing you on this, is how do you interpret the information given. Now, I'm going to take over the screen, Sandy, for a moment.
That's fine.
Yeah, thank you. So I'm just taking over Sandy's screen.
Stop sharing.
Yeah, I've taken over. So what we want to communicate to you guys is there are 2 sessions happening, right? One thing is for the people who are doing CIMA CSC May 2017, right? We've got this session that's happening, and we will cover all these 10 points, right? And we are going to, that's basically, I will send you the link for everybody. If you have others who are doing the exam as well, you can pass on this link, and this is the cost of the program. You can send these links, they can pay, and we're going to start at the end of April, right? And we're going to cover all these topics, and Sandy is going to be joining me in this session, and it's a very, very interesting industry FIS. So it's so much close to Coca-Cola, isn't it, Sandy? The other one,
fizzy drinks.
Yes, that's right, and there's a lot of things happening in that world because of the sugar tax coming on board, and then of course the investments, and there's a lot of ethical issues, so how are you going to deal with it? And another thing that we've put together for you guys is this investment appraisal recorded session that we have put together, and then we've covered all the 7 areas, and we might be adding more based on the feedback that we've got from you guys. And here again, do provide your email addresses, etc., and it's very easy. You have to make the payment and we will make things available for you. All right, so already we've got one person who's responded. Right, brilliant. Okay, so how about the top 10 issues? So I'm getting a question there. How about top 10 issues for May MCS? So Suchi, depending on the kind of response that we have, we will run a revision session. Do send me your email address if you are interested. We may have a 5-hour revision session as well, right? So you guys, we will be sending you these links. You can just very easily sign up for these sessions, and hope you enjoyed today's session with me and Sandy, and thanks a lot for joining. And Suchi, if you can send me an email directly, that'll be fantastic. Right, so guys, if you want any more information, do send me an email, but I'll be following up after this as well. All right, thanks a lot, Sandy. Thanks for spending the time with us, and
thank you all very much. Thank you everybody for coming along.
Yes, thank you.
Okay, I'm going to stop recording now. Okay, thank you all very much. Goodbye.
Goodbye.